Hey, good morning, guys. Good morning. We're going to do a point range analysis of VIX and go into the methodology of how you can use JATS-PT not only to draw levels on your chart, but point ranges as well, and how to use that on a term structure. So, what I have done is this is the daily VIX, and I've put a 19-day and a 28-day distribution on the chart. And so 19 days and 28 days, that sounds odd, doesn't it? Well, there is a method to my madness. We are on the 19th day on Monday, so July 7th will be the 19th day after the expiration of last month. Okay, so that's why the 19-day distribution. And then 28 days from the expiration to the July expiration. So the VIX calcs are no fewer than 23 and no greater than 37 and benchmarked by 30. So we usually put that distribution on the chart. In fact, I'll show it to you right here. And it's the one that I normally use for the VIX. But I like running these term structures also on my own charts. And there's a reason for that. So let me put the 24/7 on the VIX index. Change it from use instrument settings to default 24/7 because the use instrument settings is RTH and does not get that 2:15 a.m. and this does. So here's your 1, 2, 3 of the overall VIX calcs at the CBOE for the VIX expiration. And you can see that it's right in the middle, right, of these ones. In fact, we can show you, let's see, this distribution here is the 30 day. All right, the benchmark. So let's fib that and find the middle of that range, the 30-day range. 1480, 2328. So we have to be precise. 2328. I do text location extreme right, lock it in, and change this to 1480. Say OK. And then it's 1896. So 19 definitely looks like a target for the end of the month, going into that end of the month range. We're currently at 1748. So here's the term structure part, right? I talked about the term structure. Here's the daily range on the bottom. So there's two parts to the JATS indicator. The first part, which I call PT2 because I'm an idiot. I should have named these something, like JATS oscillator. It would have been so much easier. But the PT2 are three lines, PT1, 2, 3, and they go as an oscillator on the bottom of the chart. And you can use any time frame period, right? Daily, hourly, monthly, yearly. I don't use tick, volume, and range or second, but I use minute, day, week, month. The year, you have to have the data for it, and you can't get that on the VIX. They don't give us enough VIX data for some reason. They truncate it. So maybe they truncate it because the CBOE said not to use any more than 37 days, right, for your calcs, because I don't think they would be accurate. But within 37 days, you can get pretty damn accurate, let me tell you. And that's what we're going to be looking at today, right? Right now, in fact. All right, so for the daily 1 day period, and you can change from one period to 14 period. 14 periods, your standard indicator settings. You've got your RSI, your CCI, stochastics, ATR, everything is 14 period range, right? So just go with it. Or you can get esoteric. I did it at the beginning. I changed it to every period under the sun and realized, we have a lot of power to do that. We can set our own periods, but you want to see where the majority of the dealer flow is going to be. You can use the other periods to offset yourself from that so that you don't get hit, if you know what I mean, jelly bean. So you can use this to your advantage also, by being able to put whatever period you want, especially with the one period. The one period is what I call realized volatility because it's the actual realized current volatility versus the 14 period, which is historical. So when you see my RVOL, HVOL nomenclature, my acronym, it's realized one period and historical is the 14 period. And I will skew that. I will skew the one period one on the open against the one period 14 on the open. And that skew can lead me to a directional bias and or knowing whether the market is going to be wide or short, you know, expanding or contracting, especially when the current period one, period three goes outside the 14 period three. Whenever that happens, we are in tails. Okay, there's no doubt. That is exactly the line in the sand that the dealer is going to be hedging. And I'll show you what that looks like right now so that you understand what I'm talking about. So this is a 14 period oscillator. It's the PT2. It was the second version, actually. The first thing I built was this oscillator. And this was the, how us lawyers put version numbers on everything, V1, V2, V3, V4 for all of our briefs and documents. So this was V2, and I apologize for that. And so that's why I call it PT2. Like I said, that does show that I am actually a moron. Alright, so I'm going to put this down here on the same panel as my oscillator, which I'm not sure what panel my oscillator's in. We'll have to find it. There it is. I got lucky. Okay, panel 4. Alright, so here is the VIX, and that one period in or out of that 14 period will let you know whether you can run your condors or do you want your call spreads or your put spreads, or you know what I'm saying, you're running directionally outside the range. I mean, it can't get any easier than that, right? And then you can measure your dispersion outside the variance two times, three times, four times. You see what I'm saying? Outside that normal one period. So the first PT3 is 1, and then here's your 2. So it's almost like ATR, but this is not ATR. All right, it's just I've scaled it correctly on 100 scales so that I can mimic what they're doing. But the dealers are not going to be using ATR. Okay, just get over that. All right, the dealers are using the way that I measure ranges. How do I say that? I mean, why do I say that? Because you can open your eyes and see it. So there's 2 and there's 3, and you see right away that the market uses these levels historically to attract dealer hedging flow. Let's put 2.5. That was 2.68 right to the top. Look, you see that? Here's 2.5. So you can get hits. So you can see that 2.5 is, a good place, and the 3 would be where they would put their outside risk. And then where does it go? It goes back to the mothership. It goes back to the mean inside the distribution. So just knowing whether you're inside or outside the range, and but wait, there's more. These are the point ranges right here on the side. 040, the blue 2 is just above the current level. And the blue 2's at 79. The current level's at 71 going up into it. It didn't quite make it. Friday was a truncated day, remember? Holiday. And it really, nobody was trading. So, or even, I don't even know if the VIX was, I wasn't even paying attention. Yeah, I guess the VIX was on Friday. Here it is. All right. No, it wasn't. Scratch that. Thursday. Right here, that little tiny bar right there. All right. So VIX is elevating, and there are 19 days and 28 days going into between the expirations, like I showed you. So we can get a point range from the 19 days and a point range from the 28 days and run it off the high low for the month to see where the opportunity is going to be, right? One, two, three. So, and then know what the normal one period is. So the one period three, I think, is 111. Let me take this scaling thing off. Hang on one second. This is what's messing us up. The platform will allow you to auto scale it, and that squishes your chart. So I need to take that off. Okay. 111. Okay. So that's your daily range. So we can anticipate, the market closed at 1748 right here. The mean for the 28 day, or the, is this the 28? I think it is. We're right in the middle of the mean for the 28 day. We're right in the middle of that monthly distribution. Do you see that? 1748, and the mean is 1727. So we're above the mean a little bit, giving us that upside bias. Anything below that mean, anything below 1727 would give us that short ball bias. But really, it won't go long vol until we're outside that three. And you can see then that the market moves larger than these small bars inside the range. See if it's inside the distribution, very tiny bars. But whenever it goes out, you get the bigger bar. See, you get the little bigger, a little bit bigger. It went out right here. So we have a huge edge by knowing whether to look for range trading condors or to go for the outside ranges. And where are those outside ranges? What are the market makers going to be assuming they are from open interest and gamma and delta? Because that's all they use. But the dealer will use the JATS PT levels so that the risk line behind the market maker lines, if it's inside the ones, like right now we're right in the middle of the middle of the middle of the monthly range. I just showed it to you. The 19-day range is higher. That mean is higher. So that gives us that upside bias going up there. If it goes below the 1727, we're going to stay inside this daily distribution and inside of our daily ones. Where is a Let me put up a daily chart. Hang on one second. Here we go. So here I've got open and close, um, and you can see the spread between the open and the close on the VIX and how the algos will trade to both of them. Um, and you really don't need the tails in a normal situation when you're trading inside these threes, because these threes will hold most of the time. When you do need a tail, that's where the beauty of jats comes in, because jats can run tails very accurately up and down. So let's go ahead and apply our tails both for the realized and the historical. 25, 50, 75, and 1 will get you an equidistant measurement of inside the range carried outside. And you can do this not only on the 3, carrying the tail outside on the 3, you can carry it out on the 1 or the 2 as well. Right here. You can carry it outside 1, 2, or 3, and you can change the measurement. You don't have to use 25, 50, 75, 1, which would get you equal measurements. 25 would be half of the mean to 3. Point 50 would be 1 time mean to 3. The 1 would be 2 times the mean to 3. It's actually 1.25, 1.5, 1.75, and 2 outside their 3. But wait till you start fooling around with this and start moving them off the 1 or the 2 as well, and then start using, you know, other levels. You can run bib numbers or other levels. Um, okay, for instance, on May 27th, the VIX traded down below this daily 3. So you can see we had a 14 period, daily, 1 day, 14 period, which I call the daily 1, 2, 3. So the daily 3, the market on Sunday, May 27th, gapped under it right there on the daily 3, gapped down, came back, tested it, got rejected, and then sold off first to these other daily 3 levels, which was RVOL, realized volatility 3, was outside the HVOL 3. So if you understand that, the realized 1 period was leading the market down below the historical volatility. And here was your first fib. So here's your daily 1 on the open. And the second fib here, when that broke lower, is where the market went. And this is off of that 14 period close. And it went to the 68%, 0.68, outside the 3. So instead of 0.25, 0.5, 0.75, 0.1, I changed it to 0.68 because that's exactly where it went, which is a statistical level, 34, 68, 95, right there, 68. And so you're actually, on Monday, you see how it stayed inside the daily range on the 28th, which is 68% of the range also. So it stayed right inside the small flat line that we'd already broken down on the volatility, signaling the end of this upside vol earlier. And it stabilized inside the daily one. You see that? So if you look at your ES chart for that time period and take a look at what ES did, May 27th and 28th, stayed inside 68% of the range. And on May 28th, it went down to the lower two, 68% of the range. Stayed inside, and then late in the session, broke down and was held by this first daily two, where they were holding their risk. In fact, sent it back up at that point. So the twos, the 68% of the range, look, have held the market going up. Ones and twos. And that's what you want in an uptrend. So your threes down here, even though you had a two, I would have parked it just below that last two for sure. I mean, if you were selling premium and did not want to get hit, that would have been a good place. So you can use JATS PT to lean on these ranges once you understand what they are. And they're very simple: 34, 68, 95. The empirical rule. Look it up. In fact, we can do that right now. Hang on. So it's 68, 95, 99.7 rule. It's a percentage of data that falls within a certain standard deviation of the mean of a normal distribution. So 68% of the data falls within one standard deviation, 95% within two, and 99.7 within three. But if you divide the 68 into two, you get 34, 34, 68. So that's why I use the 34. Going from mean to three, actually, it's from mean to three, 34, 68, 95, lays out like you see it on JATS PT. So I did it differently, and lo and behold, that's what dealer does too. Okay, and so then when you put together all the opens and closes and 1 periods and 14 periods together using that 34, 68, 95% measurement from the mean to the three, which is what the variance trading system is. Look at the CBO website, they tell you mean to three. Um, you get the picture of how to trade, but it all boils down to whether this one is going to be inside or outside that distribution, and is it below the two. If you have a 1 period below the two of the daily, you're in low volatility. You're not going to be going outside the range. You're going to be staying inside the daily one. I hope you do get that. And it's the same thing for the intraday time frame. And when you get your daily bar moving longer volatility up, start moving off of these lower ones, moving up inside this sweet spot between these monthly means, going into expiration, which is, take a look at your calendar. When is that coming up? You've got um, a week and a half. So plenty of time to bottom bump the 1727, but anything between 17 and a half and 18 and a half could be, where we would expect to see, um, vol sellers come in. certainly at 1968. And I see a lot of all sellers, but you're inside the monthly range. You're right inside the sweet spot of that monthly range. So they're selling premium on that monthly contract. And so that's why you need to look more than just your daily. You need to look at a higher time frame structure also. And we can do that pretty accurately with the weekly, monthly charts. Put a daily bar up and a monthly distribution, which you can get from different time frames, and you can see right here we're sitting on those monthly twos as support. If if we're going long, you would want those to hold inside your monthly one. If we're going short, it's going to test that lower monthly one at 62.38 and then potentially down to these lower ones. But my guess is they would at least first attempt find, ball crushers on that VIX coming in right there at 62.38, if not already right here where they bounced it. 62.75.50. And again, that's the difference between the calcs on the open and close. So we're right in the middle of this monthly range. And if they take it to the mean of that range to match the VIX mean, um, I mean, 63.89, 61.10.75. All right, 62.47.09. So 62.50. 62.38 to 62.50, you would expect to see a lot of all crushers if it gets down there to test it, to keep that uptrend going. So this is how you can use your term structure. And again, counting the number of days like I did for, let me open this up. Oh, oh. Let me see if I can grab that. Hang on. All right, I can't grab this. I've goofed it up. And oh, there we go. All right, now I can grab it. So 491 and 445. So the PT1 is 445 for the 19 days. And and 1244 is the PT3, 890 the PT2. Okay, so if we count back 19 days, you can see that that would be within this high. So if we measure from that high to that low, where would the low be? 1614. I think that's right. So, so you can see that we're between 445 and 890, 637. So we're between the 1 and the 2. And if we want to move from 890 to 637, because 890 is the 68%, and if we want to take out the 637 that the market's already traded, we've got 253. So that's too much. So we need to do a PT1, which is 445 plus 253. So we can potentially get, 2 points, 2.5 points. So let me show you my math again. So I'm going from the 19-day point range, 890 and 445, against what we've already traded in that 19 days, 637, and trying to guesstimate where the market might be heading. Um, and the PT2 would have a potential to get up to the 890 point range in that. And if so, if we move the 637, that gives us the 2.5 point range, 2.53, that we're operating in as a potential. And to get outside of 2.53, we'd have to be above that 1.11. So just going one time that, you can see that 2.53 minus 1.11, that would give you a 1.42 um, tail. So that's quite a tail on a Monday, Sunday, Monday. We do have the Friday though, so we do have to take into account that part of that is already baked in. So that may be why we have the larger tail. Um, all right, so the ES traded down on Friday and is heading, below the ones. So we could get that lower extension on Monday, Sunday night. And that may be the reason for that extra kurtosis in the VIX. We'll see. But that would give us that upside movement towards that 1850 between the spread of my 19 and 28 day distribution. This between the middle of that. So between 111 and 250 points for Monday. So that will probably be what your dealer is going to spread tomorrow. All right. And so you could look at the ES and go outside the range, 1.5, which we know where that is. We would be looking for a move down to the 1.5 potentially of the ES range if that were to happen. So let's, see what happens. Anything can happen. They could flip the market around due to the bill signing on Saturday or Friday. What day is today? I never know what day it is. Okay, so we had the bill signing Friday, and that hasn't, we've largely baked in the move, but sell the event, buy the rumor, sell the print. So let's just see what happens going into this range. All right, term structure, you can get an idea of where you're going in the future by finding whether you're in the middle of that range or on the edges. Is the distribution moving in or out? And I can do one other thing that I haven't shown you on that daily distribution. So hang on one second. So we can change this to a 28, 29 day by just doing this. So there's 28, and here's 19. So we'll do realize 19 versus a 28-day distribution. We might as well go ahead and put a 19-day on there also. So we can put it on a 19 and 28 day. So you can see we're right in the middle between the 1 and the 2. And 608 to 890. 282. So it has a ways to go. 282 since Thursday. 19. All roads lead to 19, right? So this is probably 19 right there. Takes me to 19. I just take a look at something while I have you here. Hang on one second. 1925 is a gamma flip. So that is your point of no return. 182,000 puts versus 82,000 calls. So you would definitely say that there's some vol sellers sitting on that. Look at that. Those puts. So how about that? Expected move 15.8 to 19.16. So Jats PT again is right there. So I hope that's giving you chill bumps. Jats PT just confirmed your range. Huh. Okay, so you can run distributions on any number of days, whether you want 19 or 30 or 20 or 50 or whatever, and start playing with volatility and measuring where you are to where you expect it to go, and try to guess, pick the pin. I started playing that game with Infinitus Cap for a while using SPX, open interest, and Jets PT levels, and got pretty good at it. So you can do this too. If I can do it, you can do it. All right, guys, come get the indicator and sign up. Today's the last day for that annual sale if you would like the Substack and get my analytics for the year. I'd appreciate it. We'll talk at you later. Thank you so much. Have a good day.